Good afternoon, everyone, and welcome to today's talk. This is our first in the summer program of our virtual seminar series. I'm absolutely delighted to welcome today's speaker, who is Professor Robin Greenwood from Harvard Business School. Robin is Professor of Finance and Banking at Harvard. He's also faculty director of the Behavioural Finance and Financial Stability Project, as well as being a member of the Financial Advisory Roundtable at the New York Fed. So we're delighted to have Robin here. Robin's work really needs no introduction from me, but has spanned issues linking kind of bank capital regulation to the drivers of the size of the financial sector, to the interplay between central bank balance sheets, financial stability, debt management issues that are super relevant to the world of central banks today. So Robin is going to speak for something like 45 minutes. It's going to be the usual approach we have in these seminars. So if you have questions, please post them in the Q&A box, and you can either ask them directly or I can relay them for you, and we'll leave some time at the end for a wider discussion. Robin, let me hand the floor to you.
David, thank you so much for this opportunity. Francesca, thank you as well. It's a great pleasure to be here virtually and talking about this. I gather from David that you've had my co-author Sam Hansen, so I apologize for the surplus of Greenwood and Hansen in 2021, but hopefully you'll bear with me. It's funny, you know, you all know how this is with academic papers. This is a paper we've been working on since forever and has taken a long time. It's still not published yet, whereas the paper you heard from Sam earlier this year, we wrote and published while this one was still in working paper form. So this is it's called Reflexivity in Credit Markets, and it's also with Lawrence Jin, who's a phenomenally talented theorist. And I should say that I'm an empirical person by nature, and so it can be a little daunting to speak about theory in front of this group, but hopefully you will bear with me today. Let me ask a question to the group. It's a rhetorical question, but ask yourself where you've heard the term reflexivity. I think most of you, I'm guessing half of you, have first heard of that in one of the George Soros books or in one of the George Soros articles. And it's a term that he used to describe the idea that market expectations can influence reality. And that's something that I think is familiar in finance and economics. But I think the key thing about reflexivity is that those expectations themselves may not be rational, but that they still may play out and influence the reality that we all experience. So this is a paper about the credit cycle, and there's this growing literature that argues that credit booms are fueled in part by overly optimistic lender beliefs and later predictably go bust. You heard about some of that earlier, this term from Sam. I don't want to say that that's a new view. In fact, it goes back to Kindleberger and Minsky. And we are building here on that old line of thinking, but on some new evidence. And I would say the evidence comes in at least three or four parts. I'm just going to sketch some of that evidence for you here. In the paper that you have actually the tables that correspond to this, but this is really primarily a theoretical exercise. So I'm just going to sketch out what those results are. I will present a little bit of new empirical evidence, such as it is in a few minutes. So the first piece of evidence that we've been interested in is that credit market overheating, signaled by rapid growth in debt outstanding, a decline in credit quality of borrowers, and low credit spread, predicts low future returns on risky bonds. And as you know, also predicts financial crises, so particularly when you have credit growth that is matched with asset price growth. Second, overheating tends to predict greater downside risk in financial markets and bad macro outcomes. So Barron and Shang, Tyler Muir, Shularik and Taylor, there's a series of papers, Lopez, Salido, Stein, and Zakracek, looking at when you have high amounts of credit growth, what happens to GDP 1 year out, 2 years out, 3 years out, and so on. All of this is pretty consistent with this idea that credit markets get a little bit overheated. There's a collapse, there's a credit crunch, not necessarily a financial crisis, it could be a crisis, and subsequent declines in GDP. Third, highly overheated credit markets are associated with negative expected returns on credit and related assets, such as bank stocks. There's some evidence that Sam and I have in a paper many years ago that looks at periods when, for example, there's a lot of low credit quality firms issuing in the economy. For example, when the high yield share is at elevated levels, that means lots of junk rated debt firms are issuing compared to investment grade rated firms. That tends to forecast low rates of return on credit risk. And what do I mean by that? I mean that if you try to forecast the return on, say, a corporate bond, controlling for the return on a treasury, we're forecasting low or negative returns. So related piece of evidence by Krishnamurthy and Muir that spreads are typically too low in the run up to a crisis, but they spike on the eve of a crisis. Okay, so all of that is, I think, pretty known, probably known to some of you who are been studying this literature post-financial crisis. I think one thing that we found was really underappreciated, and we hadn't really dug into it very much, is the underappreciated feature of the credit cycle is how disconnected the credit cycle can be from other financial markets and the business cycle. And the way I always put this is the credit cycle, it kind of has a life of its own. And you can kind of put that into two forms of evidence. First, variables that forecast credit returns often don't forecast equity returns and vice versa. Okay, so and related to this, credit overheating often follows periods of tranquility when defaults are low and credit returns are high. Again, there's some evidence on this. What I'm going to show you that's new is also the credit and the business cycle can be pretty disconnected in the short run. So the best example of this is that if you look at the typical business cycle in the US in the post-war period, as the economy kind of heats up early in the business cycle, and then it slows down. But in the process of the economy slowing down, credit often continues to expand as the economy is cooling. That's what I mean by it being sort of disconnected. And what I would say is that the disconnect poses a challenge for lots of models of the credit cycle. The frictionless models, frictional but rational models, and even for some behavioral models like Bordalo, Geniaioli, and Schleifer, where basically credit is a claim on the overall economy, but it's not separate from the economy in any way. And in those kinds of models, both the frictional and the behavioral, credit amplifies and parallels the business cycle, but there's not a sense in which there's this independent credit cycle. So what am I going to do today? I'm going to present a model of an independent credit cycle that's driven by behavioral factors. I see David lighting up.
Thanks, Robin. I had actually a clarifying question myself here that I might just ask you on this slide. So when you talk about the credit cycle here, are you specifically talking about corporate credits, or do you have a wider notion in mind that includes kind of mortgage financing and consumer credits and like a wider financial cycle? Or is this specifically, do you think the disconnect is more pronounced with respect to business credits?
It's a great question. Probably worthy of more work. The way I'm going to the facts I will show you are with business credit. I think it's a broader thing. But we haven't, we haven't tried to document it in anything other than business credit in the United States. The other thing I would say is that as you listen to the model today and the story, we've told this to a bunch of people, this story, and I had lunch with Larry Summers, I think it was like 2 years ago, and we were taking him through these results. And he was saying, well, this is obviously a model of sovereign spreads. This is, what does this have to do with firms? And Samurai was kind of like, that wasn't really the way we had thought about it, but there may be some parallels to that. But I want to be a little bit careful because there's always we're guilty of this as anyone, of a tendency to try to overreach in where their story applies. What I can tell you is that we think of this as largely being motivated by the corporate credit cycle in the United States. And we're happy for it to be broader than that, and we think it probably is, but the entire structure of the model and all of that, it's all organized around firms and being able to refinance.
Lovely, thanks.
I think what's key, now that I'm thinking about your question, let me say one more thing, which is I think that there's an important feature of corporate credit, which is shared by sovereign credit, that is not so true for households. And that is that you have to roll over the debt. And for households, you typically, if you think about the way the household debt typically works, and credit card debt gets rolled over, but generally mortgage debt, it's a one-shot deal, and you have a payment that you have to make every month, but then you just make that payment going forward. And then, if you fail to make the payment, then you default on the mortgage, but that's it. So what's going to be very important in what I talk about is that the refinancing and having to return to the credit markets means that the pricing in the credit market is incredibly important every single day, right? So that will obviously be true for a sovereign. That will be true for a firm, less so for a household.
Yeah, that's fair enough. Yeah, I guess in the US, mortgage credit's very, very long term. In the UK, it's not quite so long term, but I think your point's a really good one.
But it's still true even in the UK, even if you take a 7 or a 15-year mortgage, for example. I mean, I'm not talking about in the US, the standard mortgage is the 30-year fix, right, which is insanely long. But
yeah,
or the side, basically people here do the 15 or the 30. But you're still not returning to the market except if it's advantageous to you, typically. Or if
in the UK, historically we've had a lot of maybe 2-year fixed mortgages that you do have to refinance at some point. It's an endogenous structure that changes with the level of interest rates, but that I should stop talking and let you carry on. But
that's fascinating. I would hopefully love to speak with you about that further, maybe after the talk, and just hear about that. It's interesting. Okay. So I'm going to present a behavioral model that's consistent with much of the accumulating evidence on credit cycles. It will speak to this disconnect between credit markets and fundamentals. By the way, Sam and I have been thinking that it is probably operating to some extent during this COVID period. So one of the things that we have noticed, at least in the US, is that you have all of these firms that had disastrous fundamental shocks, but actually have been able to kind of ride it out because the credit markets and the equity markets, for that matter, have been so bullish. Credit spreads have been incredibly low globally, but in the United States especially, and equity markets as well, allowing firms to finance themselves through the downturn. So you may even think of that there's at least a relationship with the COVID period. All right. What's in the model? Really 2 features that you should remember. One is extrapolation. And the form of extrapolation that I have in mind here is that lenders form beliefs about firms' future probability of default in part by extrapolating past defaults. Now, that's a lot of words, but it basically means if you were safe in the past as a firm, then I expect you to continue to be safe and not default. However, if you defaulted in the past, I'm going to assign you a higher a credit spread irrespective of your current cash flows and current distance from default. Okay, that's what we have in mind. Okay. Second key feature, and this comes from the first feature, but it's is this idea of reflexivity. And here's a quote from Soros, who I mentioned earlier. Distorted views can influence the situation to which they relate because false views lead to inappropriate actions. So the idea here is that lenders' biased beliefs will affect future defaults via the terms on which investors are willing to refinance the maturing debt. In other words, even a firm that is close to default, that with poor cash flows, that has the opportunity to roll over their debt at attractive prices, may be saved ultimately from default. Okay, so this is going to lead to a two-way dynamic feedback loop between lenders' biased beliefs and credit market outcomes. So biased beliefs at time t is going to affect market outcomes at t+1, which then affect biased beliefs at t+1, market outcomes at t+2, and so on. And as you can already see here, since people extrapolate defaults and not the fundamentals, the credit dynamics are not synchronized with the fundamentals, and they can be highly path dependent. And what I'll talk about at length is, what are your kind of come to Jesus moments here? Because at some point you do have the fundamentals of the economy have to guide the long-term evolution. And so I'll talk about eventually how the credit market and the economy align. So they just don't align in the short run, but of course in the long run they have. Okay, so this is I call it the Marcus Brunermeyer style figure, because he always has these figures, which I personally found very helpful with all the arrows floating around. Basic way to think of the model is you have these credit boom periods. The credit boom periods are sort of self-sustaining in the sense that you have low default rates, rising asset prices, slower debt accumulation. And then you have these default trap periods where you have high default rates, falling asset prices, faster debt accumulation. Think of this as the bullish on the left and the bearish on the right. And the model is going to connect how you move essentially from one state to the next. Now the model is actually continuous, so it's not that I have like literally a boom and bust states, but it's I think this is a helpful schematic. And essentially what moves you between these two is fundamentals. So eventually, if the fundamentals are really poor, of course, no matter how bullish your investor beliefs are, you are going to end up in this right part of the picture. And if fundamentals are very strong, no matter how bearish you are, eventually you'll be in this boom part of the picture.
Could I interrupt and ask you one quick question from the audience? So this is from my colleague Gulcin Ozkan, who she's kind of asking whether this disconnect between credit and business cycles is like a one-sided phenomenon. So should we think of this as something that's only disconnected on the upside, and the downswing, they end up being much more correlated, these two cycles? Or do you think of it as a more symmetric process?
Let me, Gulcin, very good question. I'll show you the evidence that we have, which is specific. I think is more about the upswing. The model will have both, in the sense that we'll have the disconnect when the fundamentals have turned, but credit is still being priced very aggressively. We will also have periods where the fundamentals, for example, you've just gone into a default, but the fundamentals have turned pretty positive, but because investors are backward looking, they're charging you high credit spreads. So the model will have both of those things. The truth is that empirically, it's harder to separate in the bad states, the fundamentals and the credit conditions. It's easier to see in the boom times because you'll have these situations where. Anyway, let me show you the evidence before I'm rambling now. Okay. Yeah. So here's some of the evidence. I actually think this would be an interesting thing to just continue to build on. this is looking at real GDP growth as a function of the business cycle expansion quarter. Okay, and it's hard to see it's downward sloping, not particularly downward sloping, but GDP growth basically, particularly for the long expansions, the GDP growth is declining later in the expansion quarters. Okay, and here is what is pretty unmistakably an upward sloping figure, which is showing you real credit growth as a function of the business cycle expansion quarter. Okay, so credit expansion, basically, it takes a while to get going. And then it's really, even as the economy is slowing down a little bit, and here I'm talking about not literally slowing down, but slowing down relative to trend, the credit expansion is particularly high. By the way, you can see this, just think about, I don't know, 2005, not just in the United States, but in other developed economies. Think about 2005, 2006, massive credit expansion, even though, you know, the economy was already slowing down pretty substantially. And you can look at, one of the things we've done is look at this business cycle by business cycle in the US, and it's actually sort of takes place in every one of the post-war periods. All right, so what's the model? The model is an infinite horizon discrete time model. There are two types of agents in the model. There's a set of risk neutral credit investors with zero rate of time preference. So what does that mean? That means that if they think that the bond is not going to default, that they will pay, and it's a 1 unit bond. I'm going to get into this, and they're obviously going to pay a price of 1 because whatever is expected to pay back next period. And then there's a single representative firm, and the firm basically can refinances a set of projects that it gets every single day or every single period. So how does this work? At time t, the firm will invest in a 1 period project with upfront cost C. So that cost is constant throughout. And at t plus 1, the project is going to generate a random cash flow xt plus 1 that follows this AR1, this mean reverting process, okay, governed by the parameter rho. Okay, so think about this as basically the cash flows, the potential cash flows of the project are kind of always moving around, and but are persistent. And then you have this C that you need to pay every period in order to keep that project going. Okay, and you can think of the people who are running these firms as kind of, I mean, maybe one way to put this is that they're just people who, they're just management, and management wants to keep the whole operation going, whether or not in any given period it's a positive NPV project. Okay. By the way, Lawrence has spent an inordinate amount of time trying to microfound this with a really optimizing firm, and to my mind, we haven't gotten anything more out of the basic intuitions when we put in full optimization of the firm and like in a Leland type setting. But I'm happy to talk about that later if you like. Okay, so firm issues a 1 period bond to finance the projects, and each bond is a promise to pay back $1 to investors in 1 period. The price of the bond, I'm going to denote that by the price PT. Remember, think of P as being, you know, less than 1, but close to 1. Okay, so if there's no expected default, obviously it's just going to always be a dollar. And then the face value of debt outstanding is F. Okay, so the firm is basically obligated to repay F dollars at time T plus 1. Okay, so how does it work? So there's sort of 2 cases. One case is that the firm just basically constantly refinances the debt. Okay, so that's this first case here, where we specify F lower bar and F upper bar. F lower bar is the lowest debt level that you can have in terms of face value of the debt. F upper bar is this maximum level where we stipulate the firm defaults, just defaults automatically. Okay. So basic idea here is as long as your debt doesn't cross that upper bar, your debt is going to evolve according to this equation here, which you can see here, this one where I put my mouse over it. See ft equals, and then in parentheses here, ft minus 1 minus xt minus c, all divided by pt. Now let me explain what this is. Remember that you are going to have to, the net cash flow that is going to come out of the project is xt minus c, because you had to put c into the project. It's going to deliver xt, which is random. Okay, and so your debt stock is going to be whatever it used to be, ft minus 1. Then what is the net cash flow contribution? So if that's positive, your debt stock is going to decline. And then, of course, you're going to have to roll it over at a price P. So, for example, if people don't think that there's going to be any default, then you can just imagine that this P is 1, right? And then you're basically, it's just the debt stock is moving as a function of the cash flows. But of course, if the expected default is very high, and for example, P is, I don't know, 0.8 or 0.7 or something like that, then the debt stock is going to grow simply as a function of the fact that people expect it to default. Okay, because so debt is going to grow faster when refinancing conditions are less favorable and when the ratio of free cash flows to debt is lower. Okay, second case is if the firm defaults, and here we'll assume that the firm will continue to operate, but the equity holders will be wiped out, and they're going to write down a fraction 1 minus eta of its debt, generating losses for its existing bondholders. Okay. There's a third case. It's not an interesting case, so that's why I said there were only two. But that's if you do happen to get into a situation where essentially you've had so many runs of good positive fundamentals, such that you basically have paid down all of your debt and you've gotten to F lower bar, then we're just going to say that the residual cash flows to the equity holders are being paid out as a dividend. Okay, basically what we're doing here is we're trying to keep the economy between this F lower bar and the F upper bar, and it's a bit artificial how we do this, but this is just so that the and in the F lower bar you're kind of end up paying out of the cash flow to the equity holders, and if you hit the F upper bar, you're in default, and so most of the time you're in this intermediate stage. Okay, so who are investors? Investors, we denote their beliefs by lambda C. Why the C? And in fact, we've been revising the paper in the past couple of weeks, and we've been trying to simplify this and I'll talk about that in a minute. But lambda C means combined, and we're combining two types of beliefs. One is an extrapolative backward-looking component, lambda B. So B here is, you can think of as backward-looking, or I think of as behavioral, and they get weight theta. And then the second is some fully rational and forward-looking component, lambda R, that has weight 1 minus theta. Okay, so just imagine, just for a second, that theta is 1, so that you don't have any of the rational players. Okay, then lambda C and lambda B are exactly the same thing. And then once theta is anything less than 1, then you have essentially some form of rationality that we've injected into the model. Okay, and so what's the bond price? The bond price is excuse me, is a function of both the fully rational price here, lambda R, you can write as the actual, from the econometrician's perspective, the probability of default. 1 minus 1 minus eta times lambda R. Why does this eta thing show up? It's because, remember, if you do have a default, you're going to write down the value of the debt. And so this eta parameter is governing how much you recover in the default scenario. Plus this mispricing term, which is a function of the difference between the true probability of default and the behavioral belief about how likely default is. Okay. And then this is the last slide of model setup, and then I'm going to just get into what some of the predictions are and how we think it matches some of the things that we see out there. So the evolution of lambda B, so the behavioral beliefs depend on past default realizations, which we denote by DT, as well as credit sentiment shocks, omega. So I'm not even going to need the credit sentiment shocks for most of the things that I'm going to talk about today. But so think about the law of motion for beliefs. This looks a bit complicated, but basically what you can see here is that you believe essentially about the default rate is going to be whatever the default rate was yesterday. That's this lambda B T minus 1. If the firm defaults, you bump up your expectation that it will default next period. And then you have this shock. We call this a sentiment shock if you want it. We can also shut that down if you want. Okay. And again, it's just motivated by this idea, by this evidence that suggests that credit investors extrapolate credit market outcomes as opposed to the underlying fundamentals of the economy. Okay, now this is a little bit complicated, and so this part I'm going to try to gloss over. It turns out that there's you can solve for the actual rational probability of default. And the rational probability of default is a function of the beliefs. And so that's what this gives you, this fixed point problem. And you end up with these multiple equilibria, much like in some of the sovereign debt work like Calvo and Cole and Kehoe. I mentioned that I've been trying to simplify the model. So we've actually as long as if you set theta equal to 1, all of this goes away, and then you don't have any of this multiple equilibrium problem. And so we've revised the paper just to get rid of that because it can kind of more focus on the intuitions that can come out of the behavioral perspective. Okay, so what does this model deliver? So one of the things that it delivers is this idea of reflexivity. And what is reflexivity in the model? It's that the beliefs impact reality, right? So their beliefs, the biased beliefs, remember, are lambda B. And lambda R is the true probability of default. And you can see how this is going to happen. So past defaults and sentiment shocks influence beliefs about future defaults. Biased beliefs affect current bond prices, and then bond prices influence the ease with which firms can refinance maturing debt. And that ease of refinancing affects the true probability of future defaults. So in other words, these biased beliefs can be self-confirming in the short run, but ultimately the cash flow fundamentals are going to tend to dominate in the long run. And the paper goes through a bunch of detail about different states of the economy. We call highly reflexive states and then non-reflexive states. So a highly reflexive state is a state where the beliefs matter an enormous amount for whether the firm gets to survive versus not. So you imagine, the simple way to think about this is imagine that basically the fundamentals of the firm are pretty crummy, and you're actually fairly close to default. So you're close to hitting that F upper bar. But if investors are bullish and they're willing to extend you credit at very attractive terms, well, you sail through that. So that's a situation where you have a high degree of reflexivity. So the outcomes are highly sensitive to beliefs. Okay. There are also some states that are non-reflexive. So for example, imagine a situation where the fundamentals are super strong and your debt levels are low. I mean, at some level, it doesn't really matter. Even if investors get to be very bearish, it's going to take a while. You're going to be able to roll over that debt, even if the price isn't fair. You'll be able to keep going for a while. That's a non-reflexive. That's one example of a non-reflexive state. A similar example of a non-reflexive state is that the fundamentals have turned so bad that no matter how attractive the debt pricing is, you're going to default. I always think of this anecdotally as an example of, at the end of a bubble period, you have the firms start failing, and they're the worst firms in the economy, and they're the only ones that even in these crazy financing conditions aren't able to make it. They must be really, really, really bad. Seeing a lot of that today, by the way. Pretty interesting. Okay. This is the picture. I'm going to skip the details of this picture because it will just take me too long, and I've only got about 8 minutes left. But this is just this is a picture showing you both lambda r and then the derivative of lambda r with respect to lambda beta. And the key thing here is that this reflexivity notion moves around a lot as a function of the parameters of the economy. Second thing, and this is what I'm very excited about this result, is that this model delivers what you could call the calm before the storm. Now, this is something that we saw certainly in the run-up to the financial crisis in 2008, but it turns out to be actually more general in some evidence from Krishnamurthy and Muir, which is that credit spreads on the eve of a in the run-up to the financial crisis tend to be too low, and then on the eve of the crisis, they tend to jump up and tend to be predictive of how bad things are. And then they tend to be too wide following a crisis. And so we actually get that in this model. I mean, it's pretty obvious why, right? Because you're kind of you're going along, the firm, nobody's defaulted. And so everybody views the firms as safe, and they're rolling over the credit at way too attractive terms, right? We can see how that would happen here. Now, eventually, the cash flows of the firms are poor, and the rational component of the beliefs kind of starts to get nervous. And when they get really nervous, the credit spreads blow out. But that really is only just before the default event, and you can see that happening here. And then, of course, the spreads blow out following the crisis, following the default event. Okay. So there's a theorem here that tries to crystallize this, but basically when theta is greater than 0, some level, the model's not interesting for theta equals 0, but when theta is greater than 0, raising the initial level of credit sentiment in the sense of reducing lambda b slows down the accumulation of debt in the face of poor cash flows, delaying or even preventing future defaults. And one of the things that we did in an earlier version of this paper is actually just produce some time series simulations where you would have kind of a world where everybody were rational, and then a world where you have these super behavioral folks. And you can end up with these spikes where in a rational world, you would have had a bunch of defaults. And in the behavioral world, people were just bullish. And so you were able to sail over those episodes with the poor fundamentals. And so anyway, this is a way of making sense of this quiet period of 2007 through 2009. I also think it's kind of an interesting way to think about what's been happening in the COVID period. Sam likes to use the term papering over fundamentals, which was something he worked in the credit markets prior to grad school, so I wasn't familiar with this, but I thought that was an interesting way to describe what was happening here. Third result is default spirals. So extrapolation here is leading to a form of default persistence that's absent when beliefs are fully rational. So, in a fully rational world, once you default, the credit risk has actually gone down considerably. So the credit spread should actually collapse. What we actually end up seeing is that when things really get bad in the economy, the credit spreads blow out and stay elevated for quite some time. So we think of this model as being probably a little closer to the actual evidence. So anyway, the implications here are moderate improvements in fundamentals may not be enough to rescue credit markets from a protracted crisis. And actually, there's some interesting work in the sovereign debt world by Carmen Reinhardt and some of her co-authors that has shown that once you enter into a sovereign crisis, you end up with a series of write-downs that actually takes I think the average number was something like 7 until the economy reemerged from the crisis. Another implication here is that a favorable credit sentiment shock may be required to help markets recover. And one way to think about what the Fed does is it tries to make investors more bullish on credit. So much of the reaching for yield literature proceeds along these lines. Fourth, I don't want to stress these results because I haven't shown you any of the evidence on return predictability, but what you can imagine is that, this model features investors who are not fully rational, and so you get return predictability. So, I mean, that's almost a theorem. I guess it is a theorem. So here I'm just computing the objective expected return from the model. What I should tell you is that the model's implications for return predictability are consistent with some recent empirical findings. So expected returns are low when past credit growth is high. It's expected returns are low when borrower credit quality is poor. And we've also done some multivariate regressions where poor borrower quality negatively predicts RT plus 1 and credit spreads positively predict future returns. I think the most interesting thing in terms of return predictability is that the return predictability, what's the right way to say this? When sentiment is high, it doesn't automatically predict low returns. And the reason is because this reflexivity concept. It's because if sentiment is high, if it sustains the boom, subsequent returns, at least in the short run, are going to be high. Now, in the long run, if sentiment is high, that's this lambda B term. Sentiment is high. Of course, subsequent returns have to be low because they're elevating the price of credit relative to fair value. But in the short run, it's ambiguous, and it depends about the precise mix of fundamentals and sentiment. Sorry, 1 second here. All right, perfect. I'm right on time. So yeah, this is a new behavioral model of the credit cycle combining beliefs and these reflexive dynamics due to debt refinancing. I think the model is useful for matching a bunch of facts about the credit cycle. And in particular, I think novel relative to other work can account for the short run disconnect between cash flow fundamentals and credit market outcomes. Excuse me. In terms of future research, thought about having a richer, less hydraulic specification. My co-authors and I go back and forth on this. To my mind, the simpler the better. But I think some folks trained in classical economics don't like firms that aren't given a optimization problem. Our firms are pretty hydraulic. And then I think there's some interesting areas of welfare and optimal policy. And as I mentioned earlier in the talk today, I personally think it's quite interesting to think of our model as at least explaining a little bit of the role of credit sentiment in driving what's happened in the U.S. over the past year. But let me stop there and hopefully have some discussion. By the way, I mentioned to David and Francesca, after the talk today, I will open up a Zoom room from say 10:05 my time until 11. I'm happy to chat with anyone about everybody's research or whatever's on your mind today. But for now, let me stop and take any questions.
Thank you very much, Robin. That was bang on time, and I mean it's a very, very elegant model and story that kind of fits with. It certainly has a ring of truth from my my perspective. So we do have a bunch of questions in our Q&A, which I could kind of relay some of these to you. So perhaps the first one, this is by Raghav Mathur, who's asking about how central banks can affect and influence these bias beliefs of lenders. I mean, one thing you said when you were describing this model made me wonder whether actually central banks should always be trying to intervene and influence beliefs in this case, because as you said, there can be outcomes where you can kind of ride through episodes which would otherwise lead to a spike in defaults. You can even have good outcomes, presumably, from your model because of these bias beliefs. So, I mean, that feels like quite an interesting set of issues to kind of unpick. So kind of what are the lessons for central banks in terms of policy intervention? And why don't you say a few words about that?
Sure. I'll say how I think about it, which is it's related to the model, but is not directly in the model. Which is, my sense is that the central bank has a role in kicking things off. And what you see in models like this is that the beliefs kind of have a life of their own that depend on a series of past experiences. And the central bank can tweak things so that they can change those experiences in the beginning. So imagine, I think the canonical example is probably, there's so much debate about, was monetary policy in the United States too loose in 2002, 2003, right? Big question, right? Mm-hmm. And one way you could think about that in this model is that the monetary policy was a little loose. It pushed people into credit, for example. So maybe through some reaching for yield story or some other story, but doesn't really matter. And then what happened is that created a life of its own in the credit markets, right? Because those both firms, and in that case, it was also other structured products, they ended up paying off okay. That people thought that they were safe, the bonds were safe. They continued to roll them over. And so you ended up in this situation where in 2006, for example, the credit markets are still singing, even though the fundamentals have turned. So that's my sense of the role of the central bank. Is it's not so much to directly influence beliefs, but it's to influence the shocks at these early stages. I mean, if you wanted to do it sort of formally, in fact, the question's a very good one, because that's why we have this term in the model. Where is it? This term right here, this last term, omega. It's basically, that's kind of like, think of it as a sentiment shock, and we think that could be, it's like the central bank has a role in generating that. Yeah, and so you might think of the central bank, for example, in the middle of a financial crisis, and this isn't really, the model isn't really about crises per se, but in the middle of a crisis, the central bank basically wants to get investors to be a little bit more bullish. That would be better for everyone, and to snap the economy and expectations out. It doesn't really have a lot of tools, right? I mean, the one that they can just change the short rate. And so that basically will push people to take a little bit more credit risk. And to the extent that they do that you could think of that in the context of the model.
That reminds me, I worked at the Bank of England in the financial crisis. And I remember in 2008, we published a financial stability report saying MBS prices had all overshot and everything was going to return back. And then they a lot further thereafter. So it shows how tricky some of these using communication to influence these beliefs can be. Let me convey another question from the Q&A. So this is by Gulchin Ozkan again. So you said something about multiple equilibria not being essential for the story, or you're trying to streamline that aspect of the model. And she was asking whether that is an essential feature of your results, that you can have this kind of switch from one equilibrium to another. Could you perhaps expand on that?
So remember that I have this parameter theta that gives you probably don't remember because I went through it all pretty fast, but theta governed the share of the behavioral beliefs versus the rational beliefs. So it turns out that you need some rational players in order to match the following fact. The Krishnamurti and Muir have showed that on the eve of the financial crisis, like right before, the credit spreads blow out. So if you don't have any rational beliefs in the model, you're not going to get that, right? Because what happens, all of your people are just looking back and they're sort of naively thinking it was safe. And so it's basically like they're running really, really fast and they're going to just boom, hit the wall. Okay. And that's going to be completely mechanical. Once you introduce rational beliefs, you have this possibility of multiple equilibria. Why is that? It's because, imagine you're close to default and you're a rational investor. Well, you could decide on a high credit spread, in which case you have a default and the high credit spread is warranted. Or you could decide on a low credit spread. Imagine you were the only investor, a low credit spread, and the firm continues to roll over. Okay. By the way, that's a feature in the sovereign debt literature as well, right? Like a lot of these papers, like Calvo, they're basically people are essentially making that type of decision. So I would say that's a well understood phenomena in the credit markets, particularly in the sovereign debt literature. And it's not really novel to what we're doing. We do, it's a little bit unfortunate for us because we need that in order to match that Krishnamurti and Muir effect. And so when I do the simple model that only has the behavioral people, we can't get that fact, but it's just it's a lot simpler in terms of the algebra, and it's very mechanical, and there's no, and so on. So that we've had that trade-off. Actually, we've been sitting on that for about a year in the revision. And like, is this what's the right way to, balance, simplicity versus realism.
Yeah, that makes a lot of sense. But perhaps I could ask you a question. So I'm wondering, like, what other stories could explain this kind of striking fact, this calm before the storm, Krishnamurti Muir fact that credit spreads are very, very low right until the last minute. Like another story I could imagine is like more of a coordination failure sort of story, whereby investors know that risk is kind of excessively priced too favorably, but it's in kind of everyone's interest to kind of keep betting. This is like the Chuck Prince kind of quote before the crisis.
Right.
You keep playing the game until. Whereas your story is more that people are kind of lulled into they have misplaced beliefs effectively. Does it matter which of those stories is true? Do they have different implications, or are they kind of the same thing ultimately?
Well, we sort of have both going on because you have to have some people to support the bubble. So I think even in the musical chair story, you need to have some people who are going to support the bubble. I think probably from a theoretical perspective, you can write down models where everyone's completely rational. These are like Blanchard Watson, maybe. I'm trying to remember back into my old macro days. But there are models like that where you're literally, every time you're rolling the dice, and it can either explode another 100% or collapse by 50, and you're okay with that. I don't find those models to be particularly realistic. Look, it's a good question. The other thing I would say is, if you just in general on the topic of bubbles, Schiller has this really great question in his surveys. I don't know if you've seen, anybody here has looked at the Schiller survey data, but he looks for I think the question is something like, do you think the market is overvalued but will continue to go up? Something like that. That's a classic bubble question. I mean, it's probably pretty elevated right now, right, in the stock market. Yeah, I mean, I think those two things are like, I mean, if once you have these coordination games in debt markets, things become very, very complicated. In practice, I think the debt markets they're much more competitive. It's not that, you have lots of little players who basically are deciding whether they're going to buy a bond or not. So
yeah, I see.
Yeah, look, anyway, this is one way of articulating this story. We've tried different ways, and I'm open to ideas of how to do it. One of the tricky parts of these dynamic models is that you can see, even though the model itself, the basic assumptions are pretty simple, it very quickly ends up in this kind of mess of parameter space and simulations and path dependency. And, most of our effort has been in trying to clean that up and make it as simple as possible to tell the story. Because, people who do theory for a living, they often want to have a clean result that's in a particular area of the parameter space and explain why this operates with, this set of conditions and not that. And that is just not the direction that we've gone with this. For one reason or another. So
let me give you a final question then. So this is again from Raghav Mature, who he's kind of interested in the idea that these behavioral ideas may be more relevant for some financial crises or financial cycles than others. And he's putting out the question, is it true that investors are behaving in a more behavioral way during the current slowdown caused by the pandemic? So do you have anything, I guess, generally to say about the present episode and where we are in terms of this credit cycle?
I could say more about the equity markets today, which is that we have lots of markers of traditional bubble markers. We have a lot of individual investor participation. We have a lot of issuance. We have a lot of financial innovation, SPACs, and so on. We have pockets of the market that are attracting things like name changes and adding blockchain to your name and things like that are always I think they're not causal, but they're symptomatic of bubble type behavior. And I think that's spilled over into the credit markets, and the combination of low rates and the bullish equity markets has given. But I mean, now I feel like I'm trying to be a Goldman Sachs analyst here. But I mean, this is just my opinion.
Yeah.
But yeah, I do worry about the markets today. It's interesting because, if you ask me, do I think the market's going to go up? Yeah, I think the market's going to go up. Do I think it's overvalued? Yeah, I think it's overvalued. So
it's a silly question. Yeah.
I think this is to David, to your earlier question. Look, the one thing I would say is amazing is the flows that are going to continue to go into the market over the next 12 months are definitely positive. Yeah. I should recommend to all of you really interesting paper by my colleague at Harvard, not at HBS, but across the river, Xavier Gabex and Ralph Corrigan have this paper about how flows into the market have this incredible multiplier in terms of price. I think they call it the inelastic, what do they call it? And I don't remember the exact title of the paper, but you can find it on their website. Basic fact, I'm not sure it's a fact, but is that, or their perspective is that $1 into the stock market raises the price of the stock, the overall value of the stock market by $5.
Yeah, that's quite astonishing.
Which it just, by the way, we probably knew that already, but they reframed it in that interesting way. You know, because I mean, if you think about it, $100 billion into the stock market, if you think about that as a flow, and you think about that affecting the S&P by 10 or 20 basis points, you say, oh yeah, that kind of makes sense. Like, that's not a big deal, right?
Yeah.
And then you kind of translate and you say, oh geez, but what does that mean for the aggregate market, which is 20 trillion, and kind of walk through how that works. So
that's a great fact. Well, let's have that to kind of draw this to an end. So thank you very much, Robin. That was a really really thrilling, exciting talk. And I think that your story, I think, is a very intuitive one that a lot of people just rings true to a lot of people, I think. Our next speaker is going to be Taran Ramadorai from Imperial College, London, and that'll be on the 7th of June. So please join us for that. But let me close this by, again, thanking Robin for a great talk, and also thanks for the offer to open up the Zoom call afterwards. So we will send the link through that to participants at this.
Thank you, David. Yeah, I'm going to send it to you right now. I'm going to log off here and I'll send you a Harvard Zoom link in 5 minutes.
Wonderful.
See you all.
Thanks again. Bye-bye.